The global financial markets are flashing a warning signal we haven't seen since the height of the dot-com bubble in 2000. This morning, Wall Street woke up to a sea of red. Dow futures are down 300 points, the Nasdaq is sliding, and even Bitcoin has tumbled below $65,000. But this isn't a random correction. This is a direct response to a 72-hour cycle of policy whiplash that has left investors, CEOs, and world leaders in a state of total shock. What happened between Friday afternoon and Sunday night has destroyed the one thing the market needs to survive: certainty. We are now trading at valuations that have historically preceded every major market crash of the last 40 years. The numbers don't lie, and today we are going to audit the damage. I'm Camilo Motato, a certified public accountant reporting for Thu News. In accounting, we value assets based on their future cash flows. But how do you project cash flow when the tax rate on your imports changes 3 times in one weekend? Today, I'm putting the US market under a stress test. We aren't just looking at stock prices. We are looking at the fundamental breakdown of the American economic engine. The chaos started Friday. The Supreme Court issued a landmark 6-3 decision, ruling that President Trump exceeded his authority. He was using emergency powers intended for national security to tax the entire world. Chief Justice John Roberts made it clear: you cannot have a permanent emergency just to bypass Congress. For a few hours on Friday, the markets actually rallied. Investors thought, finally, the adults are back in the room. The tariffs are over. But as a CPA, I know that markets hate a vacuum. That relief lasted less than a few hours. Trump's response was a masterclass in policy chaos. Saturday, he invoked Section 122 of the 1974 Trade Act, a different legal loophole, and announces a 10% global tariff. Sunday, before the markets even open, he raises it to 15%. Think about the execution risk here. If you are a retailer like Amazon or a tech giant like Apple, you spent Friday thinking your costs were going down, Saturday thinking they were up 10%, and Sunday realizing they are up 15%. This is policy whiplash, and it makes earning projections impossible. In my world, an impossible projection means a sell rating. Let's look at the forward PE ratio, the price investors pay for every dollar of future earnings. Right now, the S&P 500 is trading at a ratio of 22.2. To put that in perspective, the 10-year average is 18.8. As a professional accountant, I ask, why are people paying a premium for these stocks? This valuation only makes sense if earnings are expected to skyrocket. But the Congressional Budget Office and Goldman Sachs both confirm that these tariffs will cause GDP to flatline or contract. You are paying dot-com bubble prices for an economy that is heading into a protectionist deep freeze. This is a valuation trap. There is a massive myth that foreign countries pay these tariffs. Let's correct the record with data. Goldman Sachs found that US companies and consumers paid 82% of the tariff costs in 2025. When a 15% tariff hits an iPhone or a washing machine, the manufacturer has 2 choices: absorb the cost, which destroys their profit margin and makes their stock price drop, or pass it to you. This causes inflation, which forces the Federal Reserve to keep interest rates high. Either way, the American consumer loses. We are seeing a margin squeeze that will show up in the Q1 and Q2 earnings reports of 2026. This isn't theoretical, it's basic cost accounting. We are now entering a vicious cycle. Declining stock prices lead to a wealth effect. People feel poorer, so they spend less. Less spending leads to lower corporate revenue, which leads to more layoffs. And don't forget the political calendar. 2026 is a midterm election year. History shows that markets are extremely volatile during these periods. When you combine 1930s style protectionism, the highest import taxes since the Great Depression, with dot-com bubble valuations, you aren't just looking at a correction. You are looking at a systemic risk. Why is the dollar weakening? Because foreign investors are pulling their gold and their capital out of US custody. We've seen Germany calling for its gold reserves back, and companies like Volkswagen and Ford are moving production to Canada and the EU to escape this volatility. If you are a global investor, you want a safe haven. The US used to be that haven. But today, with a president who fights his own courts and changes trade law via social media on a Sunday, the US is looking more like an emerging market than the leader of the free world.
The final audit for this week is green. Predictability is dead.
The 15% global tariff has neutralized every trade deal the US had. We are trading at historic highs while our fundamental growth drivers are being cut off. My prediction? We will see a 10 to 15% correction by the end of Q2 2026. This isn't a dip to buy. This is a structural shift to survive. But I want to hear from you. Do you trust the US markets right now, or are you looking for the exit like the big institutional players? Are you seeing the price increases in your daily life yet? Thank you for staying with me for this deep dive. We will be here every day tracking the numbers that the mainstream media ignores. Subscribe, stay informed, and most importantly, protect your capital.